This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios in Mumbai. Mumbai with very low visibility and a little foggy and very hot and all those things this morning. It's a Wednesday morning, middle of the week. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, Prashant. Good morning. Nigel, morning. At the onset, I must say that it is extremely horrifying to see those images of what's happening across Gaza, with that hospital being bombed overnight as well. 500 people have been killed. And, of course, the implications that it will have on the economy, on not just on the economy, on humanity in general, is going to be extremely far-reaching. So, your heart goes out to all of the families, all of the children, the women who have lost their lives amidst this political battle. I hope there is a ceasefire very soon, but this is truly horrifying to see the way things are panning out.
Well, that's right. You can only pray and hope that the men in charge, a better sense prevails, and for the good of humanity and good of the globe, everything just subsides, come to some kind of an agreement and just call it off, because it's getting worrying. We talk about the Indian markets, moving up, or the global equity markets, but lives are being lost in hundreds on a day-to-day basis. So it pains you, right, to wake up to...
No, absolutely. I mean, it's a helpless feeling, right? I mean, it's terrible, it's tragic, but you just watch it and you just hope that things kind of...
On humanitarian grounds, I think things should be definitely a ceasefire.
So I think the US president is there, and maybe things will de-escalate a little bit after what has happened last night. But, we'll continue to sort of track those developments there. But let's just quickly turn our focus to markets and what you need to know as we begin another trading session. You've got overnight, the big story is the jump in yields. US yields saw a very sharp 10-13 basis point jump. The 10-year was up at about 4.83, which means that the 10-year is now that's pretty much close to the previous high. So it saw 18 basis point fall last week, and overnight we've had a 13 basis point up move. So big moves, some of these are. Now, yields moving up typically is also an indication of risk on. And, the reason why it perhaps is not risk on is because of what we were talking about earlier, which is geopolitics, right? The fallout of this is extremely uncertain. Hopefully things will quieten. The warring factions will sort of step back and hold the fire, but we don't know. So that's the reason why, although the rise in yields was indication coming off a signal from very strong US data, I think, can you take away and say that the market should be up as well? Perhaps no. So the data was strong. US September retail sales were incredibly strong, not just strong. And that kind of outweighed, the dovish Fed speak. Fed Governor Wallace spoke. He sounded dovish, but... I think the market latched onto the data and never really looked back. Actually, it's not just retail sales. You also had industrial production numbers which came last night from the US, for the US, which were also strong. As I said, it didn't translate to that risk on, and bonds did not translate to equities. Equities were lower to flat. NASDAQ actually was down about 0.25%. The S&P was more flattish. Oil prices, they inched up a little bit. I think they're up a little bit more this morning. They're up about 0.8 last night to about $90.5 a barrel. So this is, of course, the big one for the Indian market as well. Markets will watch two things. One, of course, is the speech from Fed Chair Powell. And I think this is going to be important because commentary has been so exceptionally dovish. And all the Fed speakers over the last 2 weeks have said that because market interest rates are high, we don't need to hike. It'll culminate in when we hear from the chairman of the Fed itself, the chair of the Fed itself, but that's only tomorrow. Now, tying all of this back to levels here, the Nifty yesterday could not, it by the way ended once again above the 20-day, but it could not manage to close above the recent high, which is the level that we've been putting out, 19,843. The high yesterday was 19,849, 19,850. So we almost got to those levels and then kind of turned back down once again, but not very far away, 35 odd points. The 61.8% retracement is the level above it, which is 19,883. That is also pending. So then the resistance are these two levels. The first is 19,843 and then 19,880. Support for the Nifty comes in at the 20-day moving average, which is now just under 19,700, and that should not break now. I mean, it's been ranged. It's a 200-point range. We're bouncing around, but hopefully now we're with the market being at the upper end of the range, perhaps it will be more constructive. Now, the Nifty Bank is unable to cross the 20-day moving average. That is the first resistance, which is 44,534, which is about 150-odd points out from where we closed yesterday. Recent high of 44,711 will be the next level to cross. And this is something we've been putting out for the last couple of days. And for supports, the Bank Nifty should not break the lows of 44,044. And then, of course, the 43,900 zone. These are very near-term levels within 100, 200-odd points. But that's how you need to trade this market because it's day-to-day and there is no real big momentum in the market, either up or down. It's choppy and it's cutting you both ways if you're trying to trade it. The GIFT Nifty will come up on your screen and we'll kind of pick it up from there. 16-odd points, neither here nor there. Sonia.
Absolutely. I think, what is crucial right now is to track what's happening across the globe. Because apart from the grave humanitarian and health crisis that we have to deal with, there are a lot of economic implications as well that this, Gaza conflict is going to have, especially at a time when most global markets are sitting with high inflation, dealing with high inflation. So as we know, things have escalated overnight, and that has had an impact on, asset classes like crude as well. Brent crude prices have surged to above $91 a barrel, almost at $92 a barrel now. So Joe Biden's visit to Israel will be watched very closely. On one hand, of course, Biden will be trying to show support to Israel, but on the other hand, he will also try to prevent any kind of regional conflict. So that balance is going to be crucially watched by the entire globe and not just in markets like India. For our own markets, the Nifty has been holding strong above the 19,800 mark. So amidst all of these cues, all of this negativity, the Nifty has seen a lot of buying interest. Both foreign and domestic investors bought in the cash markets yesterday, albeit the amounts were not too large. In terms of, data points, Bajaj Finance, their earnings were largely in line with estimates. The asset quality was stable. The asset under management growth came in. The AUM growth was about 33%. So decent set of numbers is what Bajaj Finance reported, largely in line with estimates. So the street could take, to that very well. Also, there was no change to their FY24 loan growth guidance of 29 to 31%. And I think that is something that the street will definitely like. So that could perhaps provide support to the market, similar to what we saw from HDFC Bank yesterday. A lot of other heavyweights will be announcing their numbers. There's Bajaj Auto, there's Wipro, Indosin, LTI, Mindtree. So we have our hands pretty full. But apart from that, I think for the next 24 to 48 hours, watching the global cues very closely would be prudent. In any case, this market has been doing well. So it's just a matter of perhaps buying time before the next leg up.
Well, that's right, Sonia. Putting all those cues on board, the global cues clearly are looking very, very cautious. And the global markets continue to remain nervous. The broader markets here in India, though, they're unfazed and they're doing quite well. But I just want to put on board there is some caution on low liquidity stocks, and we'll get to that in just a bit. The key for me today is the Nifty Bank. Can it go ahead and conquer, or will it choke at those resistance levels, which I'll get to as well? Now, first up, the Nifty yesterday did quite well. We were up 0.4%, 80 points approximately. But the breadth of the market, even better, particularly the small cap space, was up closer to 0.9%. But out here, I just want to make one point. Yes, the broader markets are looking good, and there are plenty of good quality stocks out there. But be a little bit cautious on low liquidity stocks, because some of these stocks, they're running one direction. Just want to pull up two examples. One is KIOCL. That stock is up more than 200%, just 100% just in the last 6 months or so. And ITI as well is up more than 240%. Just take a look at the float in the market. For KIOCL, it's just 1%. And for ITI, effectively, it's close to around 2.5%, or a little less than, a little more than 2% out there. So the float is very, very low. You can try to give it a fundamental reason. But the key reason that these stocks are going up is because the float is so limited in the market. And just to put up a couple of more examples, Punjab and Sindh Bank and UCO Bank, both of them as well run up big time, 35 to around 70% in the last 6 months. But in the last 1 month, both those two stocks are down more than 10%. So if you're playing these low free float companies, well, you'll have to be ready as well for a drawdown of 10, 15% or thereabouts. And that's precisely what's happened in a couple of these names. The float over there as well, very, very limited, less than 2%, less than 4% available in the market. So just want to put this point on board. Let's get to the FNOQs then. Yes, that's what we're talking about. Last 1 month or so, some of these stocks have seen a bit of a pullback. The FIs, what did they do then? In yesterday's trading session, they covered some shorts, and if you're looking at the Nifty as well as the Nifty Bank, on the Nifty Bank, the open interest was lower. The positioning is still 71% on the short side, though. The Nifty options data is quite interesting because yesterday the Nifty ended up, but if you bought that 19,850 call, you didn't make any money, because the premium moved up just a couple of rupees or thereabouts. So that's telling you there is writing being seen at those levels. But since that 19,800 put was getting written, well, the support level comes in at around 19,730. At the start of trade, the premium was 70, so you deduct 70 from around the 19,800 mark. And you have the 20 DMA as well, around 19,700. So that's the support zone. Resistance, the recent high, 19,850, that's been a bit of a resistance zone. But today, the Nifty Bank, well, it's always been important because of the large weight. But today, it's weekly expiry as well. 44,500 call was very, very active in trade yesterday. You have resistance coming in at the 20, the 50, and the 100 EMA. That's between that resistance zone, all those three resistance levels. And the recent low, just a couple of sessions ago, closer to around 40,000 odd. So those are the important levels out there. The GIFT 50 is suggesting a pullback of around 15 points. I think it can be a little deeper on that. But let's see how it goes. For the time being, we're in that range, 19,700 to 19,850, and the Nifty Bank holds the key.
Oh, absolutely. The Nifty Bank holds the key. And what we hear later in the evening from Joe Biden's visit to Israel, remember, it's imperative to halt the regional conflict for several reasons. One, of course, being what's happening with inflation across the globe, with the rise in Brent crude prices and the eventual impact this would have on world GDP as well. So a lot of implications, both economic, humanitarian and health implications going forward will need to be watched out for. But let's kickstart the show on the equities front. First up, Mahesh Nandarkar says the Jefferies economic indicator for August 2023 was down 2.3 percentage points to a 5-month low of 5.5% on festive season shift. He says some consumption-related indicators weaken month-on-month, such as the card spends, GST e-way bills and domestic demand-linked imports. He says the broader economic indicators which stayed strong include power consumption, construction, credit, trade deficit, property, etc. He adds that the RBI tightening liquidity amidst volatile crude highlights the lingering inflation worries.
Okay, well, let's get you some money market views. On rupee, we have Kunal Sodani of Shinhan Bank, who says that U.S. retail sales and industrial production data initially boosted the dollar index, but the impact was short-lived. U.S. Treasury yields rose sharply, offsetting the impact on the dollar. Oil prices surged once again, moving up. USD INR, for the USD INR, that is, we have 83.1 as support, while 83.3 to a dollar is the immediate resistance, followed by 83.5.
Okay, and on the bonds, Neeraj Gambhir of Axis Bank says bond yields traded in a range with hardening bias on account of geopolitical tensions, volatile U.S. treasuries and the OMO sale expectation. Better than expected bond auction cutoffs provided some relief to the market at the end of the week. He expects the 10-year benchmark to trade in a range of 7.27 to 7.37% range for the week.
Well, we have a lot of stock-specific action to track today, but we'll get to that in just a bit in our special Top 10 segment. We're looking at Bajaj Finance, Canfin Homes, Tata Elxsi, Hutco, as well as Bajaj Electricals. They are stocks on the back of positive news flow. While on the flip side, if ICICI Prudential, L&T Tech, Syngene and Sensor Tech as well, they are stocks that are likely to open up in the red. Happiest Minds reported a mixed quarter too.
Okay, well, Rajat Bhattacharya is a senior investment strategist at Standard Chartered. He's joining us now. Rajat, good morning. Good to have you with us here. Thanks very much. I mean, confusing price action, isn't it? A big fall in yields last week in the US, big jump overnight. Everyone seems to be just treading water, looking for direction. What's your sense?
Hi, Prashant. Yeah, pretty choppy markets there. I think all eyes are on the Middle East, of course, as you mentioned repeatedly in your call. And that's primarily because of the linkage. These are tragic incidents that are going on, but the linkage to the global markets is through oil. And there are two scenarios that we painted recently. And the first one is, of course, that whether the conflict remains constrained within the confines of Israel and Gaza, or whether it spreads out and involves other parties in the region. Iran is the key. Will Iran join the conflict is the key. So that's the other scenario. If Iran and other parties join, we are going to see some escalation. But I should add that in history, I mean, if you go back just 30 years, over the last 30 years, we noticed that these kind of conflicts, geopolitical conflicts from the Middle East, have not led to a lasting impact on oil prices. Yes, there are short-term escalations and oil prices rise, but the last 30 years of history show that these are not long-lasting. So that's good news. But you have to go back to the 1970s, of course, to see the lasting impact in those Arab-Israeli conflicts.
Sure. Rajat, hi, good morning. The other problem is that headline inflation was coming down for many countries, right? If it goes back up in an environment where we have higher oil prices, higher inflation, that can set inflation expectations to another level and make it harder for central banks to win this fight against rising prices, which most people believed we were at the end of. So how do you see central banks react from here on? And as an investment strategist, what would your call be now?
Yes, that's correct. So oil and inflation, that's the linkage again from oil to the markets. U.S. inflation, for instance, latest numbers, excluding shelter, was on the downtrend. So that was good news. But shelter is still up. But oil can, of course, change that trajectory. So this is why the yields are reacting, right? So bond yields are reacting partly because of those worries about inflation expectations staying high. Nevertheless, I think overall, in terms of answering the question on what to do with investment strategy here, the upside to bond yields is limited. We are seeing yields at around 4.8%. That's close to where we got earlier, the 16-year highs. They could go to 5%, probably. So the upside is limited. There is a huge downside if all this, evens and the monetary tightening that we've seen leads to the growth slowdown that we were already expecting. So we are expecting a growth slowdown globally as led by the developed economies next year. And that gives further upside to bonds in that sense. So the yields will come off. You get capital gains. So in terms of investment strategy, we still prefer bonds globally over equities. Now, where this conflict goes in the near term is something that we need to watch, and that again leads to our preference for bonds over equities in the very near term.
Hi, Rajat. Good morning. I recall the last time you were telling us that India contributes a far more in terms of GDP to the world GDP, though in terms of stock market capitalization, well, it's relatively lower. So that shows, the kind of headroom that India has as well from here on. But given the kind of data that's coming up from China, we just got the Chinese Q3 GDP number a few minutes ago, and that was a little bit better than what was being estimated. At current valuations, how do you toss up? If you're looking at equities, you already told us that bonds are what you prefer. But if looking at the equities and particularly emerging markets, how does India rank at current valuations with the current tensions as well?
Yeah, that's right, Nigel. So India's valuation, of course, is around, if you say forward valuations around 18 times PE versus, let's say, China less than 10. But that is justified. India stands out, as we've been repeating on this forum and elsewhere. India stands out in the emerging market world. And I'll give you some basic statistics to justify that. India's growth rate is around, is likely to be in the next 1, 2, 3, 5 years, likely to be around 6 to 7%, right? China is going to be probably closer to the 3-4% mark. Now, if you take India's real GDP growth of 7%, add to that inflation, you're getting a nominal growth of 12%. Now, historically, over the past several decades, you've seen that India's earnings growth track the GDP growth very closely, the nominal GDP growth. So earnings growth have been tracking that 7 plus 5, 12% nominal GDP growth over the last several decades. And that there's no signs of that changing. So going forward, if you're going to get an earnings growth of 12%, these valuations are not too expensive. So if you're an investor looking at 1 year or beyond, next 3, 4, 5 years, and you're going to get that 12% nominal growth, economic growth, and Indian earnings track that economic growth better than any other emerging markets, those valuations stand. So you shouldn't be out of equities. So that's not what we are saying. But so you should be very much invested in the longer term. But in the near term, I guess, the bonds look that much more attractive.
Okay, got it. At a time when, things are not looking great on the geopolitical front, right? Bonds are looking a little more attractive than equities. Thanks a lot for joining in. Appreciate your thoughts. Let's take a quick break. Plenty of stocks to talk about. Bajaj Finance's earnings and plenty of other earnings, actually. We'll be back in just a bit with our entire research team. Well, our research team is standing by to help you with the list of top 10 stocks, and there are plenty to talk about. There's Bajaj Finance numbers, there's L&T Tech that has cut their revenue guidance as well, so more on that later. But first, let's find out more about Bajaj Finance. Abhishek is here with the fine print. Abhishek, morning.
Morning. Bajaj Finance, it's almost an inline set of numbers. The NII is just 11 crores below our poll, and PAT is down by just 1.8% compared to our poll. Asset quality, gross NPA is up 12.65% in absolute value on a sequential basis. Net NPA is up 8.6% on an absolute basis on a sequential basis. So asset quality, however, as per percentage, gross NPA ratio has inched up by just 4 basis points, while net NPA ratio has remained flat. The good part is that the net interest margin decline is not as massive as the street feared. So the net interest margin on a calculation shows that there is a decline of 22 basis point YOY and by just 3 basis point on a sequential basis. Street was factoring in 20 basis point decline in net interest margin on a sequential basis. So return ratios have remained strong. ROA at 5.2% and ROE at 24%. AUM growth has remained strong, and it is largely led by the SME, commercial and mortgage mortgage portfolio, all of which on a sequential basis have grown anywhere between 8% to 10.5%. Back to you.
All right, Abhishek, thanks very much for that. That's the big one for today, which is Bajaj Finance. ICICI Pru is the next one we're going to focus on. Numbers came out post-market hours. Surbhi's got details on this one. Surbhi, morning.
Good morning. So ICICI Pru, it was a weak set of numbers. The APE was up 3% on a year-on-year basis. The value of new business was down 7%. The VNB margin, that came in at 28% versus 31% same time last year, and the expectations were around 30%. The embedded value was up 18%, but that was largely due to the equity markets doing well and the economic variance. The margin pressure was largely because of the change in the product mix. So there was more in the favor of linked and par versus the non-par, which is the higher margin product. There was pressure on the group term business, and also there were higher operating costs. Brokerages have a buy rating, but they have cut target prices for now. Investec has cut it to 625 from 665, Morgan Stanley to 665 from 685, and HSBC to 670 from 710 rupees earlier.
Okay, thanks a lot for that. That's ICICI Pru Live. But one of the big stocks in focus will be L&T Tech. The company went ahead and cut their revenue guidance, talking about macroeconomic uncertainty. Reema's here to tell us about that, as well as, Tata Elxsi. So, Reema, over to you.
So L&T Technologies' Q2 numbers were pretty good. A dollar revenue growth of about 3%, constant currency revenue growth of 3.2%, margins ahead of street expectations. But the company has lowered the full-year revenue guidance. The earlier guidance was for 20% plus. Now they're saying it will be 17.5% to 18.5%, as they are seeing longer decision cycles. There are some stress points, from the macroeconomic headwinds in various geographies. Tata Elxsi has reported a steady quarter. A top-line growth of 3.7% quarter-on-quarter. Year-on-year revenue growth has come in at 15.5%. They've managed to expand their margins by 30 basis points to 29.9%. So very close to the 30% band. So according to analysts, these numbers are slightly ahead of what the street was anticipating.
All right, and just in a while from now, we'll be interacting with the L&T Tech management on Bazaar today at around 9:30 a.m. So you stay tuned for that conversation. But let's go back to the financials and banking space. Abhishek's back with us to tell us about Canfin Homes. Abhishek, those numbers look good.
Well, the numbers were really good, Nigel. So to begin with, the net interest margin is at 6-quarter high of about 3.8% when compared to 3.48% in the previous quarter and 3.55% in the same quarter last year. Asset quality, absolute basis, gross NPA is up 24% quarter-on-quarter, net NPA is up 30% quarter-on-quarter. In ratio-wise, gross NPA ratio has come up to 0.76% when compared to 0.63%, and net NPA ratio has come up to 0.43% when compared to 0.34% in the previous quarter. Disbursements, they have remained healthy at about 2.7% growth on a sequential basis. AUM growth remains healthy at 15.7% YOY and about 2.6% sequentially. In terms of P&L, both the NI and PAT is ahead of our poll. Back to you.
All right, Abhishek, thanks very much for that. Well, let's move on. Syngene is the next one in focus. Ekta has got details on this one. Ekta, morning.
Thanks for that. Well, it was surprising because there was the guidance cut, which I'll come to in just a bit. But the numbers were okay. Revenue was up 18.5%, margins 28%, profit 116.5 crores, it was up 14%. Even on a Q-on-Q basis, margins improved. Profit was higher on a Q-on-Q basis as well. But the company has scaled down its FY24 guidance due to the slowing in the US-based biotech segment. This is basically impacting their discovery services segment. The company has scaled down their FY24 sales growth to mid-teens in constant currency versus high-teen growth estimated earlier. The company says that they made good progress in the long-term partnership with the animal health company Zoetis for one of their osteoarthritis drugs, but that's separate. What the street will probably focus on is the guidance cut, because the street was anticipating around a 30% growth for Syngene for the entire year, and now estimates will be scaled down. The reason for the guidance cut is because of the tighter funding environment in the US. Long term, they don't see any issues. Short term, there are some headwinds.
Okay, all right. Abhishek's back with us to tell us about Hutco as well as Bajaj Electric. Abhishek?
Well, Nigel, Hudco, the government is going to sell about 7% stake via OFS. The offer price is about 79 rupees per share, which if you take a look at the CMP is a discount of about more than 12%. So 7% OFS actually includes a base issue size of 3.5% and green shoe option of another 3.5%. Offer for sale for non-retail will open on 18th October and for retail it will open on 19th October. So for Bajaj Electrical, Bazaar Projects has notified the company that they have got a contract which has been awarded to them. This is by Power Grid Corporation of India, aggregating to about 347.3 crores. So it is for 765 kV new transmission line of 109 kilometers at Bazaar in Rajasthan. Now, Bazaar is an arm of Bajaj Electricals. Back to you.
All right, thanks a lot for that. Well, Rima is back with us. She's going to talk about Happiest Minds and Zensar Technology. Rima, how did the numbers look?
Thanks so much for that. So Zensar Tech has reported a flattish quarter. So it's a dollar revenue growth of 0.7%, constant currency revenue growth of 0.2% sequentially. And considering the stock has gone up 150% in the last 1 year, these numbers perhaps could disappoint the street. The management in the conference call yesterday said the demand environment continues to be challenging. They're carefully watching the situation. The weak macros continue to impact the client's tech spends. Margins on a sequential basis are on the flatter side, but there are certain one-offs. The company said the normalized margins are about 17%, but their band is to operate within 14 to 16%. Anything extra will be used to reinvest it back into the business. Happiest Minds too has reported a good Q2, but again, FY24 guidance has been lowered. The company has reported a dollar revenue growth of 3.3%. Margins have fallen sequentially due to wage hikes, but the problem is the guidance. At the beginning of the year, the company had given a guidance that they will grow 25%, organic plus acquisition. But this acquisition has not materialized. They've not managed to close an M&A. So what they've said now is that in FY24, organic revenue growth will be 12%. If they do an acquisition, it will be over and above this 12% growth.
Okay, you can catch the management of Happiest Minds and Zensar Tech later today on CNBC-TV18. Here's a quick recap of our top stocks with positive news flow. There's Bajaj Finance, Canfin Homes, Tata Elxsi, Hudco and Bajaj Electricals. While stocks with negative news flow, there's ICICI Prudential Life, L&T Tech, Syngene and Zensar. While Happiest Mind Tech reported a mixed Q2. But the big headline globally has been, what's happening with the escalations at Gaza. Overnight, there was a hospital that was bombed in Gaza with 500 people being killed. Of course, there are several economic and financial ramifications on this, the primary being what's happening with crude. Crude prices are almost at $92 a barrel. Manisha Gupta joins in for a roundup of all the action there. Manisha, not been looking so good.
Oh, absolutely, Sonia. 2% of gains overnight. We're trading at a 2-week highs right now, and we're trading at $92 a barrel on the screens here. As you mentioned, it has to do with the fears of wider conflict in Middle East, and that seems to be keeping the prices higher. Apart from that, there are also U.S. inventories which are expected to see a decline of 4.5 million barrels, as in the previous week. That has been supportive. Markets will keep a keen eye on the U.S. president visit to Israel today and the statements that come out from there. The other thing that also has been supportive for commodity markets, especially crude and metals, has been the third quarter GDP numbers that came in from China at 4.9% versus the estimate for 4.6%. The China economy has grown by 1.3% on a quarter-on-quarter basis, and that has been supportive for crude and metals in the trade today.
All right. Manisha, thank you very much for that. Well, let's take a quick commercial break here. We have Amnish Agarwal of Prabhudas Lilladher joining in with some fundamental stock analysis. A little later, we'll have analysts from Elara Securities who will join in to review the Bajaj Finance second quarter performance for us as well. Stay tuned.
Welcome back. Well, the drastic decline in small car sales should worry OEMs that are focused on sedans and hatchbacks. That's the word coming in from Tata Motors. In a chat with CNBC-TV18 at the launch of the new Harrier and the Safari, Tata Motors passenger vehicle MD Shailesh Chandra said that it isn't rural demand but bigger spending that's impacting the sales of entry-level hatchbacks. Here's a slice of that conversation that Tata Motors management had with my colleague Jude Saneth. Listen in.
It is definitely a cause of concern for players who have been strong in the hatches and sedan, because there is a continuous gravitation of the demand towards the SUVs, and therefore the hatches and sedans have been under pressure. And it will be the case because people have a natural preference to go for SUV-ish kind of vehicle, not because it is an SUV, but because it has a better ground clearance, because of the seating, command seating position, better visibility. So if at the same price point you give a car as an SUV, like a Punch as an option against a hatch, people prefer a Punch kind of a vehicle. And therefore this is a more structural decline that one is seeing. And it's not just a temporary decline. And therefore you would have seen that maybe last year H1 share of SUVs would have been 42-43%. Today it is 50-51%. And that has come completely at the cost of cars. So there is a structural shift that you are seeing in the nature of demand, moving towards SUVs because the launch activities also.
But where does it leave the entry-level segment, especially given the fact that you're seeing a 5-year low as far as entry-level cars are concerned? Analysts also point out that this is emblematic of rural problems continuing to persist. Is that cause for worry?
I would say, one, rural can be, but I don't think that's a big impact. We have not seen rural demand going down significantly in cars. It is more related to customers also going for a more pricier car, more feature-rich car. So median price of the cars have significantly gone up. Now it is in the range of 10 lakh, the median price of the cars that get sold in the country. As compared to 5-6 years back, it would have been 5-6 lakhs. So there is, in general, people are looking for more feature-rich, bigger cars. But yes, it is also because the entry-level hatches and all, people are preferring more a Punch kind of a vehicle, which is also 5.5 lakh kind of a car, 5.5 to 8 lakh. So people prefer that I'll spend slightly more and maybe buy a more car with a more higher ground clearance.
Okay, that's the word coming in from the management of Tata Motors. But let's get Amnish Agarwal. He's our guest for the day. He's the head of research at Prabhudas Lilladher, who joins in now. Amnish, good morning and thanks a lot for joining in. First, I wanted your thoughts on Bajaj Finance. The numbers look pretty good. The AUM growth was solid. The asset quality was stable. The management maintained their full year FY24 growth as well. But from a stock perspective, what's your view now?
Yeah, good morning, Sonia. You see, Bajaj numbers were good. The company continues to maintain high rate of growth. The only thing is that there has been some increase in the, you can say, NPAs. But having said that, the company, you can say, continues to deliver. It continues to look good. The only thing is that in the longer term, structurally, the price to book value can't be more than, say, 5 times or so. So I think from here on, the stock will give you more structural returns in a very gradual and steady manner.
Amnish, hi, good morning. I hope you heard that conversation with Shailesh Chandra of Tata Motors. And the part that we played out is a longer piece, but the part that we played out was the fall in entry-level hatchbacks, etc. And he clearly said players focused on that segment should be worried. Just briefly, what is happening? Is the demand curve completely moving up to, or people have generally more money, so they're able to buy higher, more expensive cars? Have costs gone up in any case? I mean, very few options available in that, under 6 lakh category. How would you look at this?
Yeah, hi Prashant. So, you see two things. If we look at your PVs as a standalone segment, then I would say that definitely there's a move towards SUVs and UVs, and that is very clearly reflected. Even a player like Maruti is now looking and gaining more share in that segment. So whatever the representative from Tata Motor has suggested, definitely there is a structural shift which is happening from, you can say, hatchbacks and sedans to UVs. Now, when it comes to, you can see your broader question that people are buying more premium, more expensive cars, or maybe say, if I expand it to more like the entire consumption basket, then one trend which we are clearly witnessing now is that whether you can say, and it is all across, whether you can say beauty products, whether it is retail, whether it is jewelry, everywhere, that the upper segment and rich segment in the country, they continue to spend. The premium products today in every segment are growing faster than the entry-level segment. Now, to us, it also gives that it is not a trend which is only visible in case of auto, but it is visible across the board, whereby the upper class, rich class, they continue to spend, whereas maybe at certain point, the lower to lower middle segments of the population are under some sort of an inflationary pressure. So I will not go into say rural and urban, because that class is there in both rural as well as in the urban India.
All right. Hi, Abneesh. Good morning. Abneesh, should give us your view on Bajaj Finance, but in terms of positive earnings overnight, we had Canfin Homes, and my colleague Abhishek just told us that their NIMs came in at multi-quarter highs, I think 6-quarter high of around 3.8%. Your view on the stock? It's positioned well because it's dealing with the housing space, the housing theme. But how do you view the stock at these prices?
You see, we have been structurally positive on Canfin because you see, ever since now HDFC has got merged into HDFC Bank. Now in the housing finance space, there are very limited number of stocks, and Canfin Homes is even now relatively, I would say, in terms of price to book, it is not expensive. Yes, there have been some concerns on NPAs or some one-time write-off which can come. But otherwise, I think the stock still seems to be very decently poised, and given the inexpensive valuations it is trading at, it will give you, I would say, very steady returns from here on also.
Okay, all right. So that's a view on Canfin Homes. Abneesh, I request you just to stay on with us. So we're just going to get a quick comment coming in on Bajaj Finance. The second quarter numbers, as we were just discussing, more or less in line. The NIMs has held up while the net profit came in a little below street estimates. Shweta, the Vice President, Diversified Financials at Elara Securities, joins us on the show. Hi, Shweta. Good morning. Thanks so much for joining in. Well, how do you read Bajaj Finance's numbers? What were the key positives and where were the misses out there?
Hi, Nigel. Morning. So Bajaj Finance numbers overall prima facie looked pretty healthy and strong, largely corroborated by the fact that now the growth run rate is on the higher side. So earlier we were estimating sort of 28-29% growth, and now our CAGR is tweaked higher to 33-odd%. So we believe, and especially now that auto financing, SME and mortgages are back in reckoning, so we believe the growth run rate remains strong. However, on the negative side, margins have come under tad pressure, but as clearly management also confidently mentioned that operating leverage benefits would continue to sort of offset the NIM pressures even going forward. So net, you will see healthy sort of rich return profile for Bajaj Finance, closer to 5% ROEs and post-dilution ROEs remaining around 21-22-odd%. So overall, a good set of numbers for Bajaj.
Okay, good set of numbers for Bajaj. If you map the trajectory of the stock, right, Shweta, from the month of March, Bajaj Finance was what, at 5,700. It's had a huge ride. It's almost at 8,100 now. How much of the good news you think is already in the price, or do you see more upsides for the stock?
Yes, Sonia, so you're right. We saw this even back in 2019. So whenever there has been a capital raising that has happened for Bajaj Finance, the stock has re-rated. So as you rightly pointed out, most of the positives currently are priced in, and going forward, the NIM trajectory should anchor the momentum ahead. We clearly mentioned that the stock momentum now on should remain slightly range bound, the kind of rally we have already seen in the stock. But yes, the NIMs, the incremental credit cost accretion that we see going forward will sort of guide the momentum ahead.
Okay. Also, the fact that they did not make any change to their FY24 loan growth guidance, right? They continue to have a guidance of 29 to 30% for FY24, and they are confident of continuing that growth momentum in the second half of the fiscal as well. How would you read into that? Were you expecting any change in the guidance at all? And do you think they'll be able to meet this kind of growth target?
Yeah, so look, first half has already set up a strong beat, a strong tone for the remaining part of the year. And given the fact that Bajaj Finance has called out apprehensions in smaller ticket segment way ahead of time, they have identified the problems they've been provided for. If you remember the con call, Rajiv Jain also mentioned that in the personal loan segments, Bajaj Finance has seen steady state market share of 7 odd percent for past 2 to 3 years. So I think they are ahead of time in recognizing apprehensions in the unsecured or personal loan segment. The growth momentum remains strong with all engines firing across product portfolios. Plus the productivity going ahead is going to compensate and help trigger the growth prospects ahead. So 29 to 31% growth is very much plausible.
Okay. Oh, all right. On that big base as well. Shweta, before we wind this down, we have Hudco that's come out with an OFS, and that stock has gone up considerably. Any view, at around 79 rupees, our retail audience would like some bit of advice if you could help us out.
Well, yeah, so given the kind of raising that is happening, we believe Hudco is very much at the position wherein things are looking strong, both from the growth as well as the return profile now. And I think it's the right time to sort of, raise money in the market. Housing finance is at an inflection point. So brighter prospects for the company ahead.
But at what valuation would you give it? I think it trades at around 1.2 times trailing price to book.
Yeah, so see, even if I compare it with the entire HFC space, so 1.2x still looks attractive, with the kind of growth trajectory we see for the company now on. So I think best of days are still ahead for Hudco, and we believe it sort of should climb at least to 1.5x. So yeah, we remain positive on the thing.
All right, Shweta, thanks very much. Great speaking with you. Appreciate you joining in with that perspective. Thank you. Amnish is still with us. Amnish, thanks for waiting. Yesterday, the standalone refiners saw very large moves. Chennai Petro, MRPL. Do you have coverage on this space? We also, by the way, had a fund manager who was saying, well, maybe this is the time to get in into some of these names. These are highly cyclical, as we know. For example, last year, MRPL, I was just saying this yesterday, started the year at 40, went up to 130 and closed at 55 rupees. So you've got to get this right when they're sort of starting to rise. I don't know if that's the time now. Some believe so. Your thoughts?
You see, like you said, that they are highly cyclical. When your refining margins go up or in anticipation of that, the stocks usually make a move. So I think at the current juncture of 112 a stock, which has started at 40, I think we are now maybe looking at last 10-15%. So we have a coverage on this. Our target is around, say, 94 rupees. Okay, so I think at 112 rupees, I think most of the steam in this stock is over unless until you are anticipating that the margins will continue to move up and the stock can give you something like your, you can say, further short-term returns from here. But definitely, these are not, I would say, the stocks one can bet on a very structural basis or from a portfolio perspective.
Okay, let's take a short break. We have many more questions for you. I do want your thoughts also on names like L&T Tech, on Tata Elxsi, because we've had some diverse, result reactions there. On the other side of the break, though, Mitesh Thakkar and Sudarshan Sukhani will be joining in for some technical trades, so do stay tuned in.
Okay, welcome back. Well, we got, 8 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with what they're making of the trade setup this morning and, of course, what they'd want you to do. Gentlemen, good morning. Good to have both of you here. It's been a bit confusing and all over the place, not just price action here, but, global markets, etc. as well. Mitesh, how would you look at it? You've been kind of avoiding trading the Nifty directly and staying more stock-specific focus. Is that the way forward?
Morning, Prashant. I believe that that's the way I'll approach the market for the next couple of days, maybe couple of weeks. Purely because, we are still seeing a lot of directional indicators turning flat, which means that no directional signal is coming through and volatility indicators mildly rising. So it will be choppy range. Yesterday, I think we again saw 19,850 being tested, but the markets kind of slipped off from there to close mildly lower. I think getting past 19,850 would be the trigger, which could, possibly get some positive traction on the indicator chart, and then we can look at a slightly better kind of or a steadier up move. Till that happens, I think it will be 19,850, 19,650 for me. And if I want to buy, I would want to buy near the lower end of the range. And since we are at the upper end of the range, I think I'll hold my horses until we see a breakout beyond 19,850.
Okay, Sudarshan Sukhani is also with us. Sudarshan, hi, good morning. How are you feeling about the market in the context of what's happening globally? Should you be a bit cautious now, or do you think that this market will move from strength to strength?
Good morning. See, we'll talk about the short term first. And the short term view is that we have reached a significant resistance level around 19,850. And together with that, we have a slightly uncertain external environment. Now, usually the markets discount this kind of environment, any kind of environment, but still, at this point, we need to be aware of it. So with the fact that we are at resistance levels and the outside environment is not very conducive, the trade is not to do anything in the Nifty and the Bank Nifty. Do not go long. Resistance levels take a lot of time to break out from, and do not go short. There is no reason to say that the market is in a downtrend. It's not. On a longer term, a longer term means, let's say for the next 1 or 2 months, Sonia, I'm upbeat on the market. We are entering into a very favorable seasonal influence for the markets, November and December. So at some point, buying should be done. But for the day and maybe for tomorrow, it's an avoid.
Okay, no trade on the Nifty for a couple of days. So longer term, the trend seems to be up. Then Sudarshan, tell us your picks. What are the trading calls you have for us?
Well, it's because of the choppy nature of the market, the trading calls are not very interesting today. But for whatever, Berger Paints had a big decline. The decline is now sort of stemmed. It is moving sideways. It's a very good quality stock. Perhaps it's a buying opportunity. Buy with a stop under 550. LIC Housing Finance has been in a trading range after a significant rally. These ranges usually break on the upside because the trend is up. Buy with a stop under 642. India Mart is in a sustained downtrend. It's an intraday short with a stop above 2850. And Naukri is another, the Info Edge, which is also in a sustained downtrend of its own. So again, it's an intraday short with a stop above 4165.
And Mitesh, what about you?
I got some reversal signs on the chart of HDFC Life, so that's a buy call. Keep a stop below 630. Look for a target of 660 here. Also a buy on Britannia, which I would want to buy once it crosses the pivot level of 4630. So buy above that, keep a stop at 4585 and look for a trading target of around 4720-25 on the upside. I have a couple of sell calls. Bandhan Bank, I think, gave some kind of a negative cross on the 2-hour chart, so there could be some pressure over here. Sell with a stop at 245 for a target of 225. And Divi's is a sell with a stop at 3700 for targets closer to about 3550.
Okay, all right. Thanks a lot for that, gentlemen. We'll come back to you for your 9:10 call. For the time being, we'll slip into a short break. We'll come back with pre-opening. We'll also get chatting with the management of Newgen Software. Don't go anywhere.
Welcome back. Let's take it straight to Rajesh Palvia, the Vice President, Technical and Derivative Research at Axis Securities, to talk about the F&O market. Rajesh, hi, good morning. Your thoughts on how to approach the market and also what are the stocks that you're looking at today?
Good morning, Sonia. So looking at the overall structure, it seems to be on the bullish side only. Looking at the Nifty setup, it's on a long side only. And the data which we have seen for the previous session, that is clearly showing that put writers are now aggressive at 19,600, 700 strike. That clearly shows that base is now shifting higher. And we may see another round of rally in the coming trading session. Once we able to cross about 19,850, then possibly another round of short covering we can see in the market. Most of the call writers needs to cover the position once Nifty crosses about 19,850 level. So that's the area where one should look at the Nifty at the current juncture. Overall, structure is bullish. Broad-based buying action is happening. Bank Nifty is consolidating at this moment. Once the Bank Nifty manages to cross over 44,650, 700 zone, then here also we can see a good amount of short covering action, and then possibly Bank Nifty can also scale up to the level of 45,000. So buy on dips is the strategy for both the indices. To play this behavior of the market, we are initiating here to buy call option of slight in the money call option of 19,750 strike. That was closed at around 101 rupees. We are projecting target for this call option at around 145 to 150. So one can buy in dips around 101 to 90 is the buying range. Keep your stop loss at around 65 rupees. The stocks where we are focusing on the bullish side, that is Canfin Home. Very strong buying action in the previous session, and stock managed to give breakout of its falling trend line in the previous session. And again, stock is now manages to hold 20-day, 50-day moving average. Looking at the overall structure for Canfin Home, we expect that this momentum can exceed, and 795, 800 could be the possible target in the continuation of this pullback. One can buy with stop loss of 755. The second stock that we like is Coal India. Very strong buying action. Stock is continuously making higher high-low formation on a daily chart. Looking at the overall series data, it's on the long build-up is clearly there. So we expect that Coal India may continue furthermore upside. 330, 335 is the next target. One can buy with stop loss of 312. And the third stock is Godrej Consumer. Short covering action is playing out in the stock. This is the third consecutive day where stock is showing good strength, and now stock is comfortably holding 200-day moving average. We expect Godrej Consumer product can continue furthermore upside towards 1,030, 1,040. One can buy this stock with stop loss of 985.
Okay, all right. Thanks a lot for that. And have a great day. The other stock that we're looking at this morning is Newgen Software. It's on our radar today. The company's Q2 earnings were strong. The revenue saw very healthy growth while the margins also expanded. Virender Jeet, the CEO at Newgen Software, joins us now to discuss their Q2 performance. Mr. Jeet, thanks a lot for joining in. In the Q1 conference call, you had said that you'll try and exceed the historical growth momentum of 20% in FY24. Where are we at now? In the first half, you saw a revenue growth of 31%. What is your expectation in the second half, and where do you see the year end?
Good morning, and thank you for having me on your call. And you're absolutely right. I think, as we had stated, that we would try to exceed, and that has been the endeavor for many years. We have done, the first half has been very good on account of our growth on core markets. I think US, India, Middle East all grew at more than 30%. So we have clocked 31% or 32% growth for H1. Having said that, we always said that the Q3, Q4 are much larger quarters for us. And I think maintaining and sustaining growth is what we are wanting. Clearly, it's looking at that we will be exceeding our historical growth rates. What numbers will hit? Will it be about 25 or about 30%? I think that we'll have to wait and watch, because still Q3 and Q4 are major quarters for us. But the business overall is looking very good. I think on our traditional markets, banking predominantly is doing very well for us in India and Middle East. And also the other markets are going right now.
All right. Hi, Mr. Jeet. Good morning. Tell us what's going to lead from here on. The license revenue or the SaaS revenue? What's going to be the growth driver? If you could give us a couple of numbers. You've said annuity in the past should go from 60 to around 75 odd. So where do you see the growth levels? And also, given that your revenue growth is going to be better, normally you do PAT margins of around 17-18%. And I'm reading a brokerage note that says that maybe it will be more than 20% for this year. You agree?
Oh, I have not read that brokerage note, but I hope that we can do that if the top line keeps on growing at this speed. The growth is predominantly coming from we sell only licenses, and and the license is either in the subscription mode or in the perpetual mode. And as depending on the market, some markets are more accustomed to paying in perpetual mode. Today, the larger growth is coming in Middle East and India. So these are markets where we sell more license. So the license growth is high. But as we start shifting more and more to mature markets, subscription growth momentums will pick up. Apart from that, the annuity growth will continue to go because it's a compounded growth. Whether we sell licenses or we sell subscription, annuity will keep on growing. On the margin front, our cost base for Q2 is typically the normalized cost base for the year. So any increment side will keep on compounding margins for next 2 quarters, and we do expect to expand our margins. But as we have clearly said that our idea is to maintain between somewhere 18-19% of PAT margins. I think we should be able to do that.
Okay, Virender, 2 questions. One, you've said that you are trying to focus on looking at getting large banks as clients, and you said insurance is also looking promising. Can you tell us if things have moved on that front? Are you closer to signing anything large? And second, would you want to give us a ballpark number in terms of the new order wins in the quarter?
Yeah, so I'll come to the second part. On the new order wins, we have done 14 new logos this quarter. And overall for the year, it's been much better than the last year. On the large bank deals, that's what the growth momentum is being driven from. In fact, even this quarter, last 20 days, we got one of the largest deals in public sector banks for us in India. And in last quarter as well, so just gone by, we've got more than 3-4 large public sector. So banking is driving the growth. Insurance is the second driver, and I think especially on the policy servicing claims, we are finding a lot of traction on the new digital journeys which the customers are taking up.
Sure.
So vertical banking and insurance being the secondary vertical.
Okay, so banking and insurance, right, is where you're seeing maximum traction. Just before we let you go, earlier you had said that the size of the deals are going up, at least compared to what you saw in the preceding years. Can you tell us what is the average size of the deals now?
I think, I don't have that number, but predominantly what we say is typically we are, at least every year we are compounding our average deal size by 20-30% on an average growth. But what is happening, unique is that we are winning some very, very large deals. In terms of which has not been the traditional deal sizes. For us has been, the larger one used to be $1 million or $2 million. Now we are reaching a $4 million, $5 million deals, which are making substantial order book size for us, which can give us a lot of revenue downstream.
Okay, all right. Just one more question, Mr. Jeet. You have exposure to the Middle East, and there's an ongoing conflict in Israel, which hopefully gets resolved soon. Have you seen any kind of pullback from your Middle East, clients? And also, do you have any direct exposure to Israel?
No, we don't have any direct exposure to Israel. On the Middle East front, right now, I don't think the current conflict is having any signs on the ground on the business side. But I think we'll have to wait and watch as the situation develops. Predominantly the oil economy generally, unless the oil prices get hit very large, we have never seen the cycles of downturn on economy unless they're related to oil price. So we are very hopeful that momentum will continue to be there.
And debtor days down to 105, do they go down from here? Just give us a quick range, what we should work with.
Our endeavor is to take it to around 90 days organically in next 1.5 years, and that's what we are on the path, and it's good. Yeah.
Okay, pleasure talking to you, Mr. Jeet. Wishing you all the best. You're sounding confident about the way ahead as well. And we look forward to having a chat with you at the end of this quarter as well. But it's almost 9:10, so let's get in Sudarshan back with us. Sudarshan, what's your 9:10 call?
Berger Paints is a buy with a stop under 550.
Mitesh, what about you?
I'll go with a buy on HDFC Life. Keep a stop at 630. 660 should be the target area.
All right, thanks a lot for that. Well, let's go across and find out what, some of the big buzzers are. By the way, in pre-opening, the rates are absolutely flat. Perhaps it's just wait and watch mode, as the market looks at what's happening across the globe. It is a cautious situation that we're dealing with on our hands. So perhaps the market doesn't want to take any directional call. That seems to be the case. In terms of individual stocks, Wipro is down about 0.5% ahead of its numbers today. And Bajaj Finance, there is a bull versus bear situation that's playing out. Abhishek is here to give us the latest on that. Abhishek, over to you.
Well, Sonia, as you mentioned, there's a bull versus bear scenario for Bajaj Finance in terms of brokerage views. So for the bulls, they are batting and saying that, growth and profitability is strong while asset quality is normalizing for Bajaj Finance. Growth outlook remains strong and no inorganic aspiration in the near to medium term from the management. So entry into new segments is also aiding growth, and most of them have raised their target price. The new target price amongst the bull, based brokerages is anywhere between 9,470 per share to as high as 9,620 per share. In terms of the analysts who are bearish on the stock, they say that the net interest margin and higher credit cost are the key negatives from Q2 results. Capital raise would be used for organic growth and to infuse into housing subsidiary as well. Now, capital raise would increase FY24 book value by about 14%. So valuations right now look expensive. So in terms of, the brokerages over there, Goldman Sachs and Macquarie, they have their target price at 7,205 and 6,300 respectively. Back to you.
All right, Abhishek, thank you very much for that. Well, Mangalam is standing by. He's got details on VST. Mangalam.
Well, VST Industries has reported their numbers yesterday post-markets, and they are very poor numbers. In fact, analysts estimate the volumes for the company, the cigarette volumes, to have declined by about 7% as well. And remember, the company has been losing market share for the last few quarters as well. Add to that, there were lower gross margins on account of higher tobacco prices, and that has caused a dent in their EBITDA as well. So to put those numbers together, 1.5% jump in their revenues, what we've seen, decline of 15% in their EBITDA, and as a result of which a net profit decline of nearly 18%. Now, why is this important? Because tomorrow is ITC results, and the street anticipates 5 to 6% volume growth coming in for ITC. So with VST losing market share over the last few quarters, and as this, the graphic plate comes up for you, you'll notice that over the last 5 or 6 quarters, VST has underperformed ITC's volume growth by a wide margin. In fact, even last quarter, where VST saw a volume decline of 7%, ITC actually saw a volume growth of 9%. So this time around, we've seen, VST's volume decline by 7%. The question is, will that be read positively for ITC ahead of its numbers tomorrow?
Okay, thanks a lot for that. So that's on ITC ahead of its earnings. But Reema's here with us to talk about the mid-cap IT space and all the stocks you need to keep on your radar. Reema.
Thanks so much for that. So the broad takeaway is that Q2 was fine, but the companies have lowered their full-year guidance. So starting with L&T Technology, they had earlier guided for a full-year revenue growth of 20% plus. They're now saying that it will be 17.5 to 18.5%. This is despite a good Q2 inline performance. Happiest Minds too. They had earlier said that growth this year will be driven at, will be 25%, a mix of organic and inorganic. Now they're saying the organic revenue growth will be only 12%. Even for Zensar Technology, the quarter has been fairly modest, a flat performance, 0.2%. That said, margin performance and the deal wins for all the IT companies have been fairly strong. The question that we're asking right now is, will the mid-cap IT outperformance over the larger, cap IT companies be tested right now? Because mid-cap IT has outperformed the larger names. So year to date, take a look at the companies which have reported numbers. Now, L&T Technology is up 25% versus the Nifty IT, which is up 11% year to date. Zensar is up 150%. Tata Elxsi is up close to about 18%. Companies are also trading at pretty expensive valuations. Zensar, for instance, is trading higher than its historical average. It's trading at 18.5 times. Its 10-year average multiple is 12.5 times. LTTS, L&T Technology, is trading at about 30 times FY25 PE. And even the other mid-cap IT companies, which have not reported numbers so far, they have been big outperformers like Cyient, Birlasoft, Firstsource, Persistent. So if we see muted numbers from IT companies, if there are further guidance cuts from the other companies, then will this entire mid-cap IT outperformance get tested? Back to you.
Okay, thanks a lot for that, Reema. Well, let's just head into the market opening, which, by the way, is expected to be absolutely flat. Bajaj Finance looks like it's going to open with a 0.5% cut. A couple of other stocks in focus. Canfin Homes is in the green. The Q2 numbers were above what the street was estimating. So Canfin Homes in focus. You have L&T Tech, where they have cut their revenue guidance for the full year. So that is something that the street will definitely not like. And lots of earnings impact coming through this morning. So let's take a look. at the first tick on the index, absolutely flat, so not doing much at all, just hanging around that 19,800 mark. No decisive move either way. The advance decline ratio is in favor of the advances at this point in time. LTI Mindtree is the one that the street definitely does not like on the back of the cut that we've seen in the revenue guidance. The FY24 overall revenue guidance has been lowered to 17.5% to 18.5%, and that's your biggest loser. Bajaj Finance is the other one, 0.5% lower now. You get this, air of caution in the market because the sensex Nifty and the Bank Nifty are now in the red, and a lot of the, heavyweights, ICICI Bank, HDFC Bank, Reliance, Britannia, Bharti Airtel, all trending in the red right now, HUL, L&T. So it's a little bit of caution on the market as we speak. On the upside, though, you have Infosys, Cipla, ONGC, Hindalco, Adani Enterprises, which are your top Nifty gainers at the moment. In fact, a lot of the, Adani Group stocks are moving with strength. So Adani Enterprises, Adani Ports, etc., all in the green. So keep an eye out on that. Then you have Tata Steel, Tata Motors, HCL Tech that are trending in the green as well. So all in all, you'd have to say it's a very quiet opening, very flat opening, but plenty of stocks reacting to their numbers. There's ICICI Pru, there's L&T Tech, and of course, Nigel will talk about the ones in the broader market as well. How's it looking there?
Well, Syngene is a stock that's getting knocked back because their FY24 constant currency sales growth guidance has been revised to mid-teens. Earlier, they were talking about high teens, so that stock has taken a knock-off closer around 4%. Happiest Minds as well. The revenue growth guidance has been, revised to around 12% on an organic basis, so that's down close to around 1.5%. L&T Tech as well, results healthy, but FY24 dollar revenue guidance has been cut out there, so that stock as well has pulled back close to around 3%. Let's pull up a few more names. Hutco, well, the government is selling 7% stake by the OFS route at a sharp discount. That one, in fact, is down close to around 8% because the base price is at around 79 rupees. That's another stock on your radar. Tata Elxsi, well, the Q2 revenue growth was up by close to around 3.5%, 3.7%. The profitability was up close to around 5.9% odd. The street likes those numbers. That stock is up close to around 2%. Pull up a few more names. Bajaj Electric and ARM got a service contract worth around 350 crores from Power Grid. I think this is the second such order coming in the last 10 days or so. So that's opened up in the green. Himadri Specialty, EBITDA number up more than 60%. Margins have expanded to around 15.7% in comparison to 9.2%. So that stock comes up for you. CIE Auto, well, the EBITDA number is up close to around 17%. Margins as well expand to around 15.2% in comparison to 13.2%. So CIE, I don't think we're getting an updated rate, but that's about that one as well. Mazagon Dock, they bagged a defense order of around 310 crores for training ship for supply. So that's been moving very, very well. And that stock again, yet again. Float, remember, very, very limited on some of these names. So please be very, very cautious on some of these names. ITI is another stock that's flying away, up 5%.
On the downside, Nigel, MMTC, right? And we were highlighting this yesterday in the closing hour as well. MMTC is down 9%. So this is the, a point about low float that Nigel has been making that we've also kind of put out. A70A just whacked down, and it's actually limit down now. Look at that. Huge volumes on that one as well. So there is a flurry to get out of the door, but not everyone can get out at the same time. So that is MMTC. What else? On the downside, by the way, market breadth is very positive. It's about over 2:1, but I'm just starting with what's lower. Hutco, we highlighted, it's down about 8%. LTTS, we highlighted 3.5% lower. It's all news related. Biocon is down about 2.5%. And ICICI Pru, there's no respite really. 2.5%, almost 3% cut. Stocks at about 518 this morning. So, that's what's coming through with cuts. On the upside, apart from what we've mentioned, there is KIOCL, again, one of those low float companies, which is up another 4%. There is still stuff happening in this low float companies, that business still going on. GSFC, fertilizer stocks, day before yesterday was the big rally. GNFC, Deepak Fertilizer, all of these names, RCF, etc. Yesterday, many stocks rallied, not as strong as day before, but you got some stuff right now as well. GSFC is one of them, which is up about 4%. I was mentioning standalone refiners. MRPL is up 3%, and maybe we can put up CPCL, that is Chennai Petro as well. Both were up 10% by close yesterday. There is Astra Microwave, which is up about 8.5%. And has got large volumes for this point in the day. Kalyan Jewelers is up about 5%. Stocks at about 308 or so. Newgen, we just had the management with us. 1,080 on Newgen. Stocks up 4%. Karur Vysya had a very good day. Numbers came day before yesterday post-market. Karur Vysya is up 4%. Godrej Industries is up 4%. Gensol Engineering is up about 6%. And there is more, but then, I mean, you'll have to sort of volumes are not really all that much if you go down the list. Chennai Petro actually is up about 4% as well. So it's it's in the broader markets, like what we saw yesterday, there's much more activity, much more action on the upside than what the index would tell you. The Nifty is down about 35 points or so, and we're at about 19,775 or so. We have a market master of the day ready with us. Saurabh Mukherjee is founder at Marcellus Investment Managers. Saurabh, good to have you with us here. Good morning. My colleague from Chennai spoke yesterday with Mr. Shailesh Chandra, MD of Tata Motors. And Mr. Chandra actually, in a way, reinforced what we've been talking about, which is the premiumization trend. He kind of said that, car makers who are focused on hatchback sedans have got reasons to worry because this is structural. It's not a near-term trend, etc. My question, though, is not about autos, but about that entire move. The lower end is doing pretty poorly. The upper end premium is doing very well. The question really is, across categories, is the pool itself expanding in a very large way in terms of, people who can buy, stuff at the premium end? Is that pool growing at a fast enough pace to sustain demand? Your thoughts, Saurabh?
So look, I mean, if you go by the income tax data that's come over the last couple of years, Prashant, people earning 1 crore or more in India, that number has doubled in the last 5 years. So income tax filings of 1 crore and upwards, the number has doubled in the last 5 years. If you focus on, say, the middle class, assume people earning between, say, 20 lakhs to 60 lakhs, that number is also moving up at a reasonable clip. What we need for the middle class number, assuming 20 lakhs to 50 lakhs is a reasonable approximation for middle class, what we need for that number to bulk up is we need the IT services sector to recover. We need outsourcing to pick up. We need the China plus one story in electronics, in pharmaceuticals to play out. By and large, I'm optimistic that this will work out. I know the IT services sector is going through a lean patch at the moment in terms of recruitment. But all the indications we are getting, Prashant, that the outsourcing of pharma research, outsourcing of payroll, HR, audit, all of that work coming to India, that's picking up a lot of steam. So just some rough back of the envelope numbers. India has 1,600 global capability centers. From what I'm seeing every day, a new GCC, new global capability center is coming up in places like not just Hyderabad, Bangalore and Gurgaon, but places like Tirunelveli, Coimbatore, Indore. So I'm optimistic that the middle class numbers will swell in the years ahead, and that will give a fillip to aspirational consumption, class consumption. As you rightly said, I think the era of mass consumption, FMCG, low-end footwear, low-end apparel, I think the era of mass consumption seems to be behind us. We're very much in an era where affluent, well-educated people get good jobs, earn more money, and power away on class consumption.
Sure. By the way, the market now is slightly moving towards the red line. So the Nifty is down about 30 odd points. The sensex is down 130 points. So it's gotten worse since the start of trade. Saurabh, hi, good morning. Very, very unfortunate times we live in with what's happening across Gaza. And of course, the implications both in terms of a humanitarian crisis as well as a financial crisis, right? Because not only are we seeing escalation of crude, but it also talks about how inflation, which world leaders were trying to bring under control, now becomes a threat once again. Would that be a concern for you as an Indian investor? And how do you approach all the geopolitical issues right now?
I think the humanitarian crisis obviously is evident and tragic. I'm not so sure, Sonia, that the impact in crude is that meaningful. Remember, the big producers of crude in the Middle East are Saudi and Iran. If they stay out of the conflict, they might have sort of proxy plays in the conflict. But if they stay out of the conflict in terms of direct engagement, it's not obvious that there'll be a huge impact in crude prices. Given the sluggish state of the Chinese economy, and given the economic slowdown / recession in Europe and America, there are no evident upside drivers on crude. And if Saudi and Iran, the two big oil producers, stay out of this in terms of direct involvement in conflict, it's not evident to me that there's a massive bull trigger for crude. Crude has been at the 90 levels for for the last month or so. Even if you go back a year, crude was at $90, Brent was at $90. And I think that makes sense to me, that more than the tragedy of the conflict in Israel, it's the global economy which fires crude prices. And the global economy, excluding India, is not in a particularly buoyant state, which is why I think crude prices are not going anywhere soon.
Hi, Saurav. Good morning. I wanted to ask you about the big boy, HDFC Bank. I think it's part of your portfolio. And, in the markets today, you're looking at a good quality company, a well-run organization, at decent valuations as well. And that's the largest stock on the Nifty. Are you all a buyer at current levels?
We look at trading at the lowest price to book in 20 years. I think it's mouth-watering. And I thought results were sparkling. If you strip out the HDFC Limited numbers, our read was in the bank, on the core bank numbers. Net interest income was up 30%. Provisioning was down 10%. Provisions and contingencies were down 10%. And if you then put in the HDFC Limited numbers, the whole scare story that the bears have built, that HDFC Limited construction book will come, the developer book will come, there's bad news there. I think that was a complete sort of fan art that people had spread. When the two entities merged on 1st July, the NPA ratio was the gross NPA ratio was 1.41. And as Sashi Bhushan said, 3 months on, the gross NPA ratio is 1.34. Strip out HDFC Limited, the bank's gross NPA ratio is 1.12. That's nearly half of any private sector bank. And all of these numbers, 50% PAT growth or 30% bank at the bank level, net interest income growth, all of that at the 20-year loan price to book, I think is just a mouth-watering. Even though it's a large part of our portfolio, I still believe it will end up being an even bigger chunk of our portfolio. Just a quick disclosure, I'm invested through Marcellus' products, so are my parents, and so are our 10,000 clients.
Sure, got it. You have, of course, believed in consistent compounders for a very long time, right? Whether it's Asian Paints, Divi's Laboratories, even something like a Bajaj Finance. And you've spoken about how these companies have a very strong moat and will continue to dominate despite the kind of competition we're seeing. How did you read into Bajaj Finance's numbers this time? I mean, they've held on to their FY24 guidance. They've spoken about a strong AUM growth. Is there more value on the upside?
So look, I think much like HDFC in Bajaj's case for the last 15 years, we've seen consistent compounding of earnings at the 25 to 30% mark. This time round, loan book and profits came in around again the 20, 28, 29, 30% mark. The reason we back these companies, right, whether it is HDFC or Bajaj Finance, is the quality of people running these companies is an exceptional level. I don't just mean exceptional by Indian standards. Compare a Bajaj Finance or an HDFC Bank or an Asian Paints. You can compare them to the best in the business anywhere in the world. This is exceptionally good management. In Bajaj's case, what I admired further was the management's willingness to give disclosure that in unsecured loans at $10,000 or below, consumer discretionary and unsecured loans, they are seeing some early signs that it's worth pulling back. And Bajaj Finance clearly said they're pulling back from small ticket unsecured loans. Again, that sort of ahead of the cycle clarity, that sort of ahead of the cycle prudence is not usual in Indian lending. You see that from exceptional firms like Bajaj. You also see very timely, very cleverly timed capital raises from Bajaj Finance consistently when they raise money, when the going is good. So from again, from the perspective of mine talking about a large holding for Marcellus, I was a very happy shareholder with Bajaj Finance's results yesterday.
Okay, all right. Saurabh, we'll let you go on that note. Thanks a lot for joining in. So just wanted to take a quick look at the market. Very, very flat, but with a bit of a negative bias.
Well, that's right. And let's get straight to the next corporate on the show. L&T Technology Services reported a good set of numbers, with constant currency growth coming in line with street estimates, although the company has revised their FY24 growth guidance, cutting it to around 17.5% to around 18.5% from 20% earlier. Reema caught up with Amit Chadha, the MD and CEO of the company, and began by asking him about the quarter gone by and their rationale for trimming the guidance. Let's hear him out.
3.2% constant currency, 7 new deals signed, out of which the 6 of them are actually near $20 million. Not just that, in fact, in the first 2 weeks in October, we have signed 3 additional deals, one of them more than 10 million in cybersecurity, leveraging the SWC capabilities, and 2 of them more than $20 million, again, all global customers. So we do see deal making happening. We're very pleased with what we've been able to close. Having said that, there is a macro environment that's out there. There is a caution, if I may. People are being careful. And we have taken all that into account as we have reset expectations to come in between 17.5 to 18.5. I should, however, tell you that we will continue to work and see what we can do towards the upper end or more if possible, and come back and update in January again.
So you're trying to focus on achieving the upper end of the guidance. If not, at least beat it.
Yes, please.
Okay. What about the margin performance? Your margin performance, even after absorbing the wage hikes, you've managed to clock in margins of over 17%. Could you give us the margin breakup? And your earlier guidance was to achieve 17% margins by Q4 of FY24. You've already done it in Q2. What could the revised guidance look like?
So margins for us, if you remember, prior to coming together with Smart World, we were at 18.5 plus percent in EBIT. And with Smart World, we've achieved 17.2 last quarter, 17.1 this quarter. I do have confidence we will stay in the 17% range for now. Of course, our ambition is to get up to above 18% again. What you realize is that on one side, we've got wage hikes, but on the other side, we have got pyramids that we can continue to fine tune. There are freshers that we continue to hire, train, and deploy. In addition to that, we continue to automate some of the work that we're doing. So all those are positives for us, if I may. Finally, if you look at it, is the kind of work that we do. We are continuing to improve the kind of work that we're doing, more high-tech, that takes us away from a commodity business, puts us in a more specialized niche that allows us to be a premium engineering and technology provider for our customers.
You did say the United Workers strike in the United States impacted revenues in Q2. There was a loss in revenues on account of that. Could you quantify that? And what have you baked in terms of a loss of revenues on the back of this UWS strike, the delay in ramp-ups in the second half of the year?
So we had a very slight change because of the strikes to the extent of less than 50 bips in growth. But we did have that, and we have factored that into quarter 3. We do, we wish all the best to all the sides, but we think that we're just looking at it as an extended furlough season, if I may, in some of the projects that we execute, and we are trying to get beyond it now with various other wins that we've had.
Q3 will be seasonally soft for you, right? And you're expecting growth to bounce back in Q4. What could Q4 look like?
I would say Q4 will look like similar or slightly better than Q2.
Got that. North America growth was just 0.7% on a quarter-on-quarter basis. Can you tell us how corporate client behavior is currently?
Sure. So if I was to quantify the US, actually some of the US growth shows up in our India numbers because those are Indian purchase orders that we get from American clients. That's the way to look at it. But clearly, US is in that 0.61% range. And we are seeing growth avenues and opportunities in transportation, which we grew at about 4%, in plant engineering, which actually did very well and bounced back at 4% for us. And then somewhat in industrial products and medical. High-tech continues to be a challenge. We've had issues in Semcon and hyperscalers, consumer electronics. But I do believe that January onwards, those clouds should dissipate, given the new Semcon chips that are coming out. So broadly, I do believe that the US should do better Q1 onwards, Q4 onwards.
You spoke about very strong deal wins. Now, the conundrum is that why is it not translating into revenue growth for the entire industry per se? Can you tell us how your pipeline is? How does it compare with what it was 3 months ago or 6 months ago? And what has changed in the deal pipeline for you?
Sure. So one, if I look at the deal pipeline, there's a lot more 50 million, 25 million deals. There are some 100 million plus deals that we've got. We didn't have this a year ago. It's even improved in the last 3 months. It's there. So our deal pipeline is bigger. It's just that taking a little longer decision cycles, and now we are adjusting and getting used to it. So we are putting out multiple proposals to see which ones will close first. Also, the deal tenures are slightly increased. So where a deal tenure was, say, about 2.7 years in duration or 3 years in duration, they all extended now to 3.25 or 3.5 years in duration. So there is a little bit of expansion there that you see there. Overall, ER&D is supposed to grow. I mean, if you look at the latest reports coming out, ER&D is supposed to have a CAGR of about 8 to 12% in the next few years, actually reaching up to going from the $280 billion currently to $750 billion by 2030. ER&D in India is supposed to go from $45 billion to about $170 billion by 2030. So there is opportunity. There is there could be a very near short term, shall I say, seasonality in Q3, but we do expect stuff to continue to roll on and roll up. In fact, there's about 2,000 freshers that we are getting on board this year. More than 1,000 have already been onboarded. Remaining will be onboarded in the next 2 quarters. And we are starting to firm up numbers for recruitment for next year as well. So we continue to go about our operations.
Any deals which have gotten cancelled?
We haven't had any deal cancellations.
So just elongated decision-making cycles and some delay in ramp-ups?
Yes, please.
Okay. Tech budgets for your ER&D, tech budgets for your clients, do you think they will be growing in FY24? Will they be on time?
So interesting you asked that question, because the same report that I was referring to actually talks about, and this was done in October, sample size of about, I think, 300 executives across ER&D, and the results were that at least 70% feel that their budgets will be the same or expand, while there was about 30% of the respondents said that they could either see flat or slightly lower budgets for next year. So I would say that this is still in play. I would come back and check sometime in December, January, and as to how things turn out and turn up.
Okay, that's L&T Tech Services down almost about 3.5%. The street definitely not happy with the kind of revenue cut that they've seen in their guidance, or they've delivered in their guidance. Let's slip into a quick break. On the other side, we'll focus on the festive season demand. It's Navratri, and we'll find out whether people are buying, what are they buying. Amit Agarwal, the Group Chief Financial Officer at Raymond, and Lalit Agarwal, the Founder and Managing Director at V-Mart Retail, will join in. Later in our special segment, Quarter Se Quarter Tak, we will focus on the steel sector. Amit Dixit of ICICI Securities will be with us.
Welcome back. Well, the markets are more or less flattish, but let's get you some sound bites as well that are coming in. For appliance makers like TV, refrigerators and conditioners, the festive season that spans between August to December is by far the most lucrative of the year. These months typically account for around 30% of the full year sales. CNBC-TV18's Shilpa reports that this year is of more significance as it comes after 2 disappointing seasons, and manufacturers are hoping that the Cricket World Cup will add that extra bounce to the pitch.
The festive season of 2022 and the summer of 2023 did not give consumer durable manufacturers and their dealers much to smile about. The summer months of April and May, when air conditioners and cooling appliances are usually in high demand, actually saw sales fall 25 to 30% despite heat waves and a delayed monsoon. But August, the beginning of the festive season, has given players reason to hope.
15th August was super bumper this year. And I'm not talking in terms of sales alone, because sales every year, 15th August is good. But this time we saw the maximum number of footfalls coming in and converting into sales. I feel the consumer is in the mood of buying, and hence we expect a good season this year. Something which we have not seen, I think, in the last few years. So what we are expecting starting from 15th, that is the first Navratri, till 19th of November, when the World Cup finale happens, we expect this year at least anything growth of 20% and above.
Heavy interest in online shopping festivals is also giving brands confidence. Amazon, for instance, says more than one appliance was bought every second in the first 48 hours of its online festival, and half of these were premium appliances. Similarly, one TV was bought every second, with demand being higher for large screen and 4K TVs. The boys in blue have played their part in preparing the pitch.
Typically, we do not consider this as a good retail period, but given the World Cup fervor, I think the consumers are buying into televisions right now. So we've had a fantastic response on the online sales that we are seeing right now. But at the same time, we are also seeing a great response in offline.
Premium products continue to do better than mass market products, a trend that has been visible for a few years now.
During the festive season, by and large, mid and high and premium products sell. And we hope that once we move into the beginning of the next season, mass will pick up again. But in our industry, over the last few months, we've seen a bit of a slowdown in the mass segment.
Unlike the usual flurry of discounts and gifts, most brands and retailers are betting on EMIs and easy consumer financing options to make appliances more affordable this festive season. The hope is that such a move will not only attract new consumers towards high-value products, but it will also encourage upgrades. Now, another added advantage for appliance makers is that unlike the last few years, there is no overhang of rising input costs this year, and that could translate into higher margins. In Mumbai, Shilpa Ranipeta.
Interesting one out there. But let's get a pulse of how things are moving on ground. To help us out with that, we're going to be joined by the management of V-Mart as well as Raymond to discuss how festive season is shaping up on the whole. Let's go across to Mr. Amit Agarwal first, the group CFO at Raymond. Hi, Amit. Morning. Thanks so much for joining in. I'm just looking at some data points that my colleague Surbi has given us. She's saying there are around 35 lakh weddings in 23 days between November and December. What's, what kind of feedback have you got at your stores? Is there, enough traction, or are you seeing some signs of slowdown?
No, absolutely. I think we are seeing a similar kind of attraction. And actually, it is very evident, as you saw, that the Navratri first day happened on a Sunday of this week till Saturday. It was basically the Pitru Paksh, and the people were not buying. And we have seen that as soon as the Navratri started, the footfalls in the stores have increased dramatically. And if I compare to a Sunday sales of the last week to this Sunday sales, it has seen across the country moving from 25% up to 45% up on the same day basis. So it is actually, we are seeing, and all the dealer, distributor, franchisees have been talking very, very positively that this time what actually retail has not been doing well for last 6, 7, 8 months is going to see come back with a vengeance, so to speak, in the next, from October onwards till the month of March. We are seeing a full recovery coming back into this period. And effectively, all our products are lined up at various stores.
Got it. Lalit Agarwal is also joining in. He's a founder and managing director at V-Mart Retail. Lalit, good morning and thanks for joining in. How has the start of the festive season been in terms of demand? And can you give us some details on what are the demand trends that you've noticed so far?
Good morning, Sonia. Yeah, definitely cheers are up and festivals are on. We started seeing the first sign of festival right from the markets in Eastern India. That is what Durga Pujo market is all about. So it's in the peak of Durga Pujo, and then we are seeing good response in Eastern India. We have noticed some growth over last year as well in the same stores, and we are excited about this festival, and we believe because of lot of things getting assembled into this quarter 3, and including festival, winters, and weddings. So this quarter 3 is going to be a very good quarter, and we should see a very good growth coming in.
Okay.
Mr. Agarwal, sorry. This period aside, I mean, just to kind of tie this in with slightly longer-term trends, we just had the government data, the Labour Force Participation Survey, which was released. It's an annual thing. And what it kind of confirms is that, while the number of people who call themselves employed has gone up, it's seen a good growth, but it's mostly in the self-employed category. If you look at the quality of jobs, which are well-paying jobs, I mean that is actually it's fallen. That is not doing very well, and this is I'm talking about data from F5 18 or so all the way till FY23. So just your thoughts, sir. I mean, how this impacts, a business like yours, because, that's the kind of slightly longer-term structural story here.
So I understand, and Prashant, we definitely believe that most of our customers, and more than 60% of our customers who are in tier 3 towns or the hinterlands of Bharat, are largely self-employed people, and that's how the economy runs in India, because that's how the Bharat economy is all about. Because we don't have too many offices, we don't have too many industries out there. So that's still coming up. But yeah, I believe still these data, because these people are self-employed and these are the people who employ people, and that's how the data gets released. I don't know what's the government data talking about, because still not too much of formalization has happened over that job employment market. But I think there is a lot of good news coming in. People are employed. We are not able to find ample of people on our stores. When we open up a new stores, we definitely find it difficult now to get the employees getting recruited. We have seen some attrition coming in. So that's showing up the demand of the economy in the economy, where the job is available and employment is available. So people have to work, and then and I think this is a lot of good news that is coming. I don't know the data that you are saying. I have not gone through that data, but I think the self-employment going up itself is a great news for the economy.
Got it. Just before I go back to Amit, Lalit, I wanted your thoughts on some numbers, right? When you say that festive demand is picking up, sales have increased between 30 and 40% since Pitru Paksh. Can you put a number on the same-store sales growth? What has it been in this quarter so far? And compared to, say, the preceding few quarters, has the average gone up? Just to understand.
You're asking me, Sonia?
Yes, Lalit. This question is for you.
Definitely. See, I mean, we have seen in Eastern India, at least I can say you that, I mean, we are seeing greater than 10% of same-store sales growth being recorded from a festival to festival perspective. But we expect a more sales to come in, because now the winter is also kicked in. We had seen rainfall only 2 days back. So the chill factor has come into the northern India. And as you know, V-Mart has a large base in the northern India segment. So we would expect a lot of sales coming in, even from the pre-winter and the winter products. And that's going to be adding up the sales in the coming festival. So we are very hopeful here.
Okay. And Amit, I wanted your thoughts on what kind of sales that you are expecting this wedding season, considering the record high weddings that we're expecting to have, especially in ethnics. What would the sales growth look like?
So actually, the ethnics, we have got almost 92 stores now ready to service the market. And based on these stores, we expect a very strong increase. But it is just about 2 days what we have seen, where the sales have increased dramatically. I think we will have to wait for another 20 to 25 days to see how people are coming out and shopping. And then it would be the right comparison in terms of numerics to say that this much is an increase we are expecting. But what we hear from our dealer and franchising network is that it is going to be a very strong season, comparatively even better from the last year.
Could you put some numbers to it, Amit? This season as opposed to the previous season, what kind of growth?
So look, it is very difficult at this juncture to talk about it, because it's still to see come back, and because it is just 2 days of the festivities have started. I think we will have to see people coming to the stores. Maybe another 25-30 days, we would have been in a better position to talk about the numbers.
And we will ask you again in 20-25 days. But
sure.
Given feedback from dealers, etc., what's your sense? I mean, a ballpark range. This compared to the previous one.
Compared to the previous one, we are seeing positive trend. To put a number is difficult at this juncture.
Okay, all right. Putting a number is difficult. Lalit, would you want to do that?
I did speak
you mentioned the 10% figure. Yeah.
We are seeing almost a 10% figure from a period-to-period growth, because what we say Durga Puja to Durga Puja, or now we'll focus on Diwali to Diwali. So that's how we track it. And we are seeing a good growth coming in.
Was this not recently, but let's say pre-COVID, or this used to be much higher, right? In the festive period?
So this is festive to festive, Prashant. You please understand, what we are comparing is festive to festive and not week on week or month on month.
Correct. No, I'm saying that in prior years, before COVID, what was this growth rate, in the festive season? I mean, sales used to go up sharply, much higher than 10%, or is 10%, what you used to see earlier as well?
So the base also has that 10% growth, which we got last year, or whatever 6% growth that we got last year. So on that base, we are seeing another growth coming in, because post-COVID, we never got back to our original sales, and we are expecting this year that we will surpass that original sales, and that's what the entire industry is expecting, because that's how the lower strata of the economy, because the monsoon has been very good. There have been good news coming in. Inflation rates are going down. So I think, vegetable prices are going down. So all of these factors which actually pull down our consumerism, the basic Bharat consumer, these should actually bring benefit this year. So that's the expectation that we have during this festival, because this time the customer is going to come out and spend and fulfill most of their wishes.
Okay, all right. Thanks a lot for that, gentlemen. Have a great festive season, and hope both of your businesses do well this time. I'm Amit and Lalit. Thanks for joining in on the show. Let's move on to our special segment, Quarter Se Quarter Tak. Nigel will tell us the key expectations from the steel sector this quarter. Nigel, over to you.
Well, steel companies, they should deliver a strong set on three big factors: lower raw material cost, strong demand momentum despite the seasonally weak monsoon quarter, and benefit of reporting on a low base that's in Q2 FY23. Let's get a little bit more specific and look at the key highlights and the key factors at play. Now, Kotak estimates volume growth of around 8% on a rather low base. The average realization is expected to be down by roughly around 2.5 to around 3,000 rupees per ton. But flat prices, well, they were a little bit more resilient, while long product prices, well, they saw a sharper decline. It could be because it was monsoon season as well. Now, this was mostly offset by lower coking coal costs, which dipped by around $45 to around $60 on a per ton basis sequentially. But we have witnessed a sharp jump in coking coal prices towards the end of September, and that can limit gains for the second half of this fiscal. Iron ore costs as well are likely to remain a little bit softish, should be down by around 3 to around 4% on a sequential basis. Let's get to the EBITDA per ton basis though. We can see a sequential improvement for both JSW Steel as well as SAIL in particular. Now, Nuvama says that SAIL is estimated to be an outperformer, as it will benefit from two factors. One is the rise in volumes, which can jump as much as around 20% sequentially. And also, it's a little bit more sensitive to the fluctuations that we see in coking coal prices. So when it moves up, they get hit harder. When it moves down, they'll benefit a little bit more. And as I said earlier, there was a fall that we witnessed in long product prices due to monsoons. JSPL, well, they'll bear the brunt because they have a higher exposure to long products, which will lead to the EBITDA per ton actually contracting sequentially. Tata Steel's Europe operations, well, the losses will continue and they're expected to expand. That's because of lower volumes, weak prices, as well as high cost of inventory. Now, the key monitorable from here on will include the recent spike that we've seen in coking coal costs. How does that limit gains for the second half of this year? The progress on the capex, namely JSPL, because they have a big capex plan out there, and also commentary on demand from China in particular and other developed countries. The margins where they're expected to remain steady for ferrous firms, even in the third quarter. This, as the exit prices were higher for the last quarter, towards the end of September, that is. But this will be offset by the rising coking coal cost. Well, before we wind down, let's give you a quick snapshot of how the valuations stack up. As you can see, normally you have SAIL that trades at the lower end of the multiples, both on the EV upon EBITDA as well as price to book, while JSW Steel is a relatively more expensive in comparison to the other names. Back to you guys.
Okay, thanks a lot for that. So that is a strong quarter that we're expecting for the steel sector this time around. Mitesh Thakkar joins us now to give us a quick picture of what's happening. Mitesh, since the markets are flat, let me ask you about some of these steel stocks. Fundamentally, things are expected to look good this quarter, but technically, how are you positioned?
So I actually like the sector. We have some long positions on Tata Steel, disclaimer, so there's vested interest. I think the sector or the other steel stocks have corrected a bit, and you will see SAIL, last swing high was 103, now is at about 85, and made a low of 85, now is at about 90, is trying to reverse. So I think all these stocks have gone through a period of correction and a pullback. I think they are just in the process of giving some kind of reversal on the upside. Once that happens, you will see a good momentum rally happening in the steel stocks. I expect maybe in the next 2-3 days, we should see some breakouts happening over here.
Mitesh, Astra Micro is flying away. Started 5-6% higher, was up 10 minutes back, 13-14% now. How's this one looking?
Oh, it's been doing that for many weeks now, Prashant, and today was a fresh breakout. Now, this is a very strong momentum, and typically, when a very strong momentum breakout happens in an overbought situation, it could see a few days of very strong up move, and then you could see some kind of a short-term peak being made. So my idea would be to trail the stop losses over here. The current recommended level, which I would suggest, is closer to about 472, which is actually today's low. But you can, during the day, as the hourly averages keep moving up, you would want to keep revising the stop loss. I do suspect that this fast rally could see the stock price head towards 600 plus levels, which is where some profit booking should happen.
Okay, all right. Thanks a lot for that, Mitesh. Well, a couple of stocks are moving around, though. Power Grid has moved to the low point of the day, so I think it makes sense to pull up the intraday chart out there. While Cipla has found its form yet again. Actually, pharma stocks on the whole are doing very, very well. And Cipla from the Nifty pack, that's the big mover. It's moved to the high point of the day. The street is waiting by whether or not that deal does take place or not. For the time being, stock moves to the day's high. But let's focus on a few more stocks that are on the move. Surbhi joins us. She's tracking ICICI Prudential. Surbhi?
Thanks so much for that. So it was a weak set of results from ICICI Pru. The APE growth was up 3% on a year-on-year basis. The value of new business that was down 7% on a year-on-year basis, and the VNB margin that came in at 28% versus 31% same time last year, and the analyst expectations were around the 30% mark. The embedded value that was up 18%, but that was largely due to the economic variance. Now the margin pressure that has come because the change in the product mix. Now this time around, the product was in favor of linked and par as opposed to non-par, which is the higher margin product. There was the pressure on the group term business, and also there were higher operating costs. Now, largely brokerages have a buy rating, and there are some positives that have come. They've said that the ICICI Bank channel drag on APE growth will be limited from now on. There is strong growth in the retail protection segment, which was a positive according to them, and the company continues to invest in technology, which will drive growth in the future. Apart from that, valuations are inexpensive, currently trading at 1.6 times FY25 price by embedded value. They are largely positive, but still cut target prices to some extent. Investec has cut it to 625 from 665 rupees per share. Kotak has cut it to 650 from 675, and IIFL has cut it to 660 from 710 rupees earlier.
All right, thanks a lot for that. Well, Ekta is focusing on Syngene this morning. Ekta, what's the latest there?
Well, it did come out with its Q2 numbers. Syngene is in focus on account of that. But the disappointment for this quarter, despite the numbers actually meeting expectations, is the fact that they've cut the FY24 revenue guidance. I'll come to that in just a bit, but first the numbers. Revenue up 18.5%, so no problems there. We had EBITDA at around 254 crores, margins at 28%, which was year-on-year stable, as well as profit, which was up around 14%. Q-on-Q as well, the margins did see some amount of improvement, and there was a higher profitability sequentially as well. Now, coming to the FY24 guidance cut disappointment, they have cut their FY24 sales guidance due to slowing growth in the US biotech segment, which basically impacts their discovery services segment. Hence, the company has scaled down the guidance for FY24. They now expect mid-teens growth in constant currency versus high-teen growth estimated earlier. The company separately is positive about the long term, but in the near term, this slowdown in the biotech funding because of a higher interest rate environment is going to impact their revenue going forward. Now, companies, however, on a separate note, has said that they've made long-term good progress in the long-term partnership that they have with the animal health company Zoetis. This is a partnership that they had signed some time ago and had started showing in the numbers Q4 onwards, and that's one of the key participants in terms of revenue growth this time. For the company, it's expected to be a big opportunity for them.
Okay, thanks a lot, Ekta, for that. Well, let's slip into a short break. On the other side, we'll get back to talking about the quarterly expectations from the steel sector. Amit Dixit of ICICI Securities will join in to give us his expectations. Stay tuned.
Welcome back. Well, before we get to the steel discussion, just pull up MMTC. The stock is down close to around 10%. I'm looking at the BSE. There are more than 7 lakh sellers out there, and there are not many buyers. So that's why that stock is actually at lower circuit. We've been highlighting this point that some of these stocks, they're floating like butterflies, but be careful, they can come back and sting like a bee as well. So just be careful of some of these stocks that have run up a goodish bit. You pull up a year to date, you'll see the stock has been flying away. But now, in fact, the problem is when you have to exit. So be a little bit cautious on low float stocks, do a proper analysis, and then, in fact, make a move. So keep an eye out on that stock. It's down close to around 10%. And many such stocks as well has moved up on very, very low float. But as promised, let's get straight to Amit Dixit, the analyst at ICICI Securities, who joins us on the line to discuss expectations from the steel sector in Q2. Well, Amit, good morning. Thanks so much for joining in. Well, the key factor for the last quarter is going to be coking coal cost. I was just looking through various reports, and they're indicating $40 to around $60 per ton cooling off on coking coal cost. How much are you factoring in?
Yeah, hi, good morning, Nigel. So we are factoring in $40 to $50 per ton lower cost.
Okay. And at current prices, how does it, compare with the average that you're considering for the past quarter? Because the problem is towards the end of September, beginning of October, suddenly coking coal costs have spiked up yet again.
Yeah, so that's a very relevant point. What we have seen that coking coal prices, if you look at last, let us say 1 month, they are up almost 19 to 20%, and the move is still on. So clearly, that will have a bearing on the spreads. However, the steel prices have also moved up. In fact, people have taken hikes towards the beginning of October, and our channel checks indicate that there could be more hikes also if the coking coal prices remain this robust. On the spreads front, well, if coking coal prices remain there where they are, and steel prices also, remain where they are, definitely there would be an erosion in the spreads, spot spreads, that is, to the extent of 1,000 to 1,500 rupees per ton in this quarter. But having said that, we will have to see how the quarter pans out. Still, we are in the beginning.
Okay, so for the past quarter, though, where are you working with a positive surprise? Sale is on a very, very low base, so those numbers could look, relatively better. But for you, what are you factoring in terms of a positive surprise? And where do you see, negative surprise? Tata Steel Europe is going to deliver a loss. But which are the two stocks that you'll be looking on the positive and the negative side?
Yeah, so, sale, as I said, it is definitely going to show better improvement in EBITDA per ton, mainly because of the fact that, the other companies, their realizations increased in Q1 on QOQ basis because of prior priced exports. Now, sale doesn't export much. So clearly that kind of erosion we won't see, that delta. And therefore, sale is expected to perform better in terms of realization in this quarter. And add to it the fact that they are actually most dependent on external coking coal. So any decline in coking coal would affect them favorably. Coming to the negative side of it, well, again, if you look at Tata Steel, I think Street has already factored in the number. So we are expecting around $150 per ton negative EBITDA, mainly because price and cost have offset each other. However, there would be relining expenses at Iodine that would be expensed out. And that would be around $50 per ton. So that is the delta between this quarter and the last one. However, this has to be considered not exactly in a negative way, because the relining is important for the life of the furnace, and the advantages would accrue in the quarters or the years to go by.
So this $150, for Tata Steel, you're factoring in $150 negative EBITDA in the European business. That's actually worse than what the Street is estimating. So on the stock price, I wanted your thoughts, because, the stock has done nothing for investors if you map a 1 year or even a 2 year journey, right? It's been hanging in that 100, 120 range. Is there anything in these earnings that can take it out of that range?
No, so nothing is there in the earnings, to be honest. The earnings would be very lukewarm, let me put it this way, because whatever in India operations, they will make India operations EBITDA definitely would be better compared to last quarter. But having said that, Europe, as I mentioned, would be down. So therefore, overall EBITDA, in fact, would be lower compared to last quarter. So this is not a stock that one should actually concentrate on for this quarter or something. I think the benefits will flow in once the UK operations is streamlined, as they have guided the restructuring of UK operations. So it's a story that one has to look with a little bit of long-term perspective.
What about GMDC and Hindustan Copper? GMDC, in the past you have tracked it. I don't know whether you have official coverage out there. But do you think that some of these stocks have run ahead of themselves? What would your view be, particularly on both these two government-owned names?
No, so, Rajal, I don't cover GMDC and Hindustan Copper, formally here. Having said that, in case of GMDC, well, the recent run-up in stock price can be attributed to the fact that government is contemplating lowering the royalty rate for rare earth. I think they have phenomenal reserves of rare earth which is being explored currently. So I think it has to do with that. As far as Hindustan Copper is concerned, again, no official coverage on the name, but I believe the stock will go along with the copper prices. People are factoring in that global copper prices might be in for an uptick because of the supply issues, particularly in Latin America. So I think that should be the driver for the stock. But having said that, we don't have an official coverage on these stocks, so can't really comment on these.
Amit, just one word, on GMDC, you don't have official coverage, but this rare earth opportunity is very, very big. What is the nearest possible guesstimate that you can give us that they actually start mining this rare earth, production starts out there? Because it's still a few years away, right?
Yeah, you're right. That's still a few years away. The proof of pudding is in eating. So we still have long way to go before we can mine the first kg or ton, whatever you call it. So can't really put a guesstimate over here because there would be exploration costs. There would be various costs that would be associated with it.
Okay, all right, Amit, thanks so much for joining in. So the big factor in the last quarter is going to be coking coal costs cooling down by $50 to $60 per ton. SAIL could report a rather good set, on a relatively lower base. And for Tata Steel, revival of the UK operations will give direction to the stock. Let's stick with commodities and the commodity markets. Manisha Gupta joins us to tell us what she's tracking. Manisha?
Well, thank you for that. I'm talking about the wheat prices, which have seen a strong run-up overnight, nearly a 1.5% of a gain. And with that, we are up by nearly 22% now in last 6 months for the Indian wheat prices. This is the highest that you've seen in 8 months now coming in for India. And there are various reasons on why the prices have been running up. To begin with, Maharashtra, which is one of the major producers, the 6th in the row really, has cut area under, wheat planting. The expectations that because we've seen lower monsoon season this time around, so Maharashtra could move away from chana and wheat and go in for millets like maize, bajra, etc. And that's really supporting the prices for a couple of those commodities. Also, when it comes to wheat, it needs 4 or 5 rounds of irrigation, which Maharashtra perhaps cannot afford this time around. So you could be looking at lower wheat production this time. Apart from that, it also has to do with the festival demand. In any case, the winter period is a peak demand season for wheat. You have the maximum wheat demand in India between the months of November to January. And with the way the markets are right now, with market totally dependent on the government OMSS schemes, there is some concern now coming in because of the supplies here. Also, when you look at the import tax in India, that stands at 40%. Industry for some time has been talking on whether or not the government will ease that. We haven't seen that happen until now. Also, when you look at the government stocks itself, that has been on the weaker side. On 1st of October, it is standing at 24 million tons versus the 5-year average of 37.6 million tons. Remember, last year wasn't such a great one, and versus the target that government put at 34.15, it could procure only 26.2 million tons, and that clearly has been supportive. If you look at the overall crop numbers as well, while we are looking at a higher crop this time around and a record number that the government put out at 112 million tons, the street estimate is that you perhaps are not looking at any more than 100 million tons, even lower than the last year, and that has led to some concerns within the trade as well. If you look at the various government measures that we've seen in case of wheat, well, you have India banning wheat exports in May 2022. You also do have stock limits when it comes to holding wheat. That was cut down from 3,000 ton to 2,000 tons currently, and while the government is selling wheat in the open market scheme, it is lesser. And in Delhi, we've seen the prices almost surge to around 27, 28 rupees a kg, with expectations that 30 is not too far away.
Very much for that. Well, commodities and agri-commodities in focus this time. Just two names I want to put out, MMTC and STC India. These are part of that list of stocks which have been rallying very hard recently. The common thread across these names has been the very low public float. Both are limit down 10%. MMTC and STC India are the two that I can spot. Maybe similar stuff on other names as well. Names like ITDC and a few others had been going up very, very sharply. What is going up sharply is Orient Cement. I mean, this morning, if you can have the intraday up, it'll tell you it's up about 10% or so, and a lot of the move has come in the last 15 minutes or so of trade. There you go, 12.5% now on Orient Cement. Markets in the green, so it's looking much better. 22 points higher, so the bounce has come, and we are very close to the recent highs. 19,832. The high yesterday was 19,849. I mean, that's basically the zone that you need to get past. We'll continue to track things, but for now we have to take another quick commercial break here. But on the other side, we'll play an excerpt of the exclusive conversation with the Chief Economic Advisor, V. Ananta Nageshwaran. My colleague Lata caught up with him. That's coming up.